Good morning and welcome to the Island Park Private Wealth's Monday morning market recap. We hope everyone had a safe, warm weekend and you all survived and are dug out from Snowmageddon. So, as normal, we're going to give you a little brief overview of what we saw taking place in the markets last week and some of our key takeaways from last week's price action and what we're looking forward to this week. So markets were choppy this past week as policy headlines drove shifts in risk sentiment. Tariff-related developments sparked early week volatility, though conditions stabilized as concerns eased. The major equity indexes like S&P 500 and the NASDAQ finished the week little changed, but leadership continued to rotate beneath the surface. Small cap, value, and equal weighted indexes outperformed, while technology stocks and the growth factor weighed on market cap weighted benchmarks. In the fixed income markets, treasury yields rose across the curve, causing bonds to trade lower. Corporate credit spreads remain extremely tight by historical standards, and high yield continued to outperform investment grade. Commodities were an area of strength, with gold rallying again to highs amid the policy uncertainty. So here are some of our key takeaways from last week. The policy headlines trigger brief tariff scares. Markets were rattled this week after reports that the White House threatened new tariffs on European countries tied to negotiations involving Greenland. The headlines sparked a spike in volatility in early part of the week, with the stocks and the U.S. dollar selling off as investors reacted to the prospect of renewed trade tensions. Treasury yields moved higher, with the 10-year reaching its highest level since August, while gold climbed to new highs as investors sought defensive positioning. Volatility then eased later in the week after officials walked back the tariff threat and signaled a potential deal framework, allowing stocks to rebound. The market's reaction was driven more by uncertainty rather than lasting economic impact, reinforcing how short-term news can generate market volatility without changing long-term fundamentals. Point two, the big picture trends remain in place. So the market's major trends remain intact despite the headline-driven volatility. Leadership continued to broaden beyond the mega-cap tech companies, with small cap and equal-weighted indexes outperforming and signaling stronger participation beneath the surface, even as the headline indexes declined. So while the major indexes pulled back, the underlying rotation suggests investors are reallocating rather than exiting equities. In the bond market, Treasury yields continue to rise across the yield curve, and corporate credit spreads remain tight. And gold continues to push to new highs, reinforcing its role as a hedge against policy uncertainty and market volatility. The volatility did not disrupt underlying market trends. The continued strength of assets like gold, alongside shifting equity leadership, highlights how diversification can help portfolios navigate uncertainty and volatility. Point three, economic conditions largely remain unchanged. As the data backlog created by the government shutdown continues to be cleared, the economic backdrop appears broadly unchanged. Labor markets continue to cool, industrial activity is soft, and housing demand is improving, and consumer spending has proven to be resilient. So the mixed but stable backdrop hasn't generated new inflation or growth signals that would require a policy shift. It allows the Federal Reserve to remain patient and monitor how these trends evolve before considering additional policy changes. Point number four, the Fed meeting preview. Markets head into this week's Federal Reserve meeting expecting no change in policy. Investors expect the Fed to leave interest rates unchanged as inflation continues to ease while economic growth and the labor market remain resilient. This combination gives policymakers little urgency to move quickly. So markets will be focused on how officials frame the inflation progress and their thinking around the timing of potential rate cuts later this year. Point five, gold and Bitcoin diverge. Gold and Bitcoin moved in different directions this week, underscoring how the two assets can behave differently despite being grouped together. Gold rallied to new highs amid the policy uncertainty and demand for defensive positioning, while Bitcoin gave back last week's gains. The divergence highlights that while both are viewed as alternative assets, they tend to respond to different market forces. Gold is more tied to defensive and hedging demand, while Bitcoin is more sensitive to shifts in risk appetite. And that's it. That's our Monday morning market recap. We hope you have a great week. If you have any questions, you know how to reach us. If you like what you hear, please hit the subscribe button and pass along to your friends and families and colleagues. Thank you. Have a great week.